Yeah, good evening. Glad to have you on board with us tonight. It's March 26th and my presentation number 1115. I'm Steve Carver speaking with you from Dunn, North Carolina. And I'll just tell you right up front, I'm not a lawyer or a tax accountant. I'm just a fellow that's been in business for 64 years, still in business right now, very active with my farm equipment business, which I speak of oftentimes and use as an example of different marketing tips that might help y'all. But my first advice is always, and the same tonight, ask for second opinions. Get someone that you can bounce your ideas off of. Don't make major decisions in the dark when you have plenty of people that'll help you as you work. And I'll mention to you that we do have small business centers set up to help entrepreneurs in all of our community colleges. And the one that's sponsoring us tonight is the community college at Rocky Mount, North Carolina, Nash Community College. And that small business director is Ruthie Holloman. She is really great, really smart, very helpful, and will do everything she can to help you get started. So if you want to set up an appointment, and everything is free and confidential, give Ruthie a call at 252-451-8344 or drop her an email. It's on your screen here. She'll be happy to help you get started, and as I will any way that we can. The small business centers really work hard to help folks. After tonight's webinar, you'll get an email from me. I'll have your email addresses, and if you would look for that email, go ahead and stay up and click on the link and fill out the survey form for Ruth if she needs that for her paperwork and to justify continuing the webinar series. And also you'll have a chance to tell her what other subjects and topics that you might want to be included in the series. So please fill out that survey and send it in. It's very important to her. You will have received email if you registered early with the different handouts that are available to you for tonight's lessons, and they're very thorough, full of good information. I hope you'll take time to look at them and use them, and I'll be mentioning the different study guides and handouts as we go along. The one that's number 1115 is actually a summary of tonight's class. This class, as I was telling Jody a little earlier, this class is wrapping up a 6-part series tonight, and I appreciate y'all being with us through the series. On Tuesday night, April the 9th, that's Tuesday week, we'll have an afternoon class, 2 o'clock in the afternoon, which is talking about tax preparation. This class will be very similar to what we're doing tonight. So if you feel like you missed a little bit of what we talked about tonight and you want some more information, then join us back on Tuesday afternoon, and I'll send you information about how to log into that. And then the next night, on the 7th, on April the 10th, we'll start a brand new series of 7 classes, 7-part course, Academy series, so that you're able to win certificates and awards if you attend the classes and do a little bit of homework and get your business started in some ways. We'll be happy to have you join us as new, and all of you that have been with us in the past and you want to continue to keep joining, you're welcome to join on as many times as you'd like. Each time you complete a class, you'll move up in level of membership in the Academy as you move up in your level of expertise in small business running. We've had 5 people that after tonight's class will qualify for Academy membership and also achievement awards. We've had about 26 attendees as we've gone along through the series, and we've had 5 folks that will be getting certificates and awards, and I certainly do appreciate your attendance. So let's talk about that. Congratulations to you folks who have achieved your goals and moving your business forward. And our first in class tonight is Darcy. Darcy is with us on board right now, so congratulations, Darcy. We are so proud of you. You are our first in class, and basically that's an award that I recognize the person that has really just poured their heart and soul, and they're moving the business forward. And I know you've been working on this for 2 or 3 years, and finally got your first year in business tonight. So this is very appropriate that we're the first ones to give you a great big salute and congratulations. And in doing that, you also get your extra mile award certificate. They're already in the mail to you, and I'll look forward to getting some pictures back from you. Hopefully you'll get them and take a picture and send them to us. As you've now completed at least 2 series, you have advanced in membership as an advanced associate. So you can take that advanced associate certificate and $2 or $3 and maybe buy a cup of coffee. But you know how hard you work for it, and I do too. And I'm so proud of you for getting to that point. The class, you'll be a Master's 1 and Master's 2 and so forth as we go along. Tia Starika gets the Extra Mile Award as well because she has really juiced up her marketing. Lots of videos, lots of Facebook presentations. Just so proud of her. And I hope y'all will visit each other's websites and Facebook pages and encourage each other. So Reiki gets an Extra Mile Award as well. And by finishing another series, she moves up to a Master 1 level of membership in the Academy. So congratulations for that, Mr. Reiki. Look at here, Dusa Maria is with us tonight, and so proud of you from New York City and hanging in there and finishing out the course. And I hope you'll continue to join us as well. And you've got your certificate, and we'll move on up the line as you continue to stay with us. Again, I've got a couple of more people that may qualify if they attend tonight and also send in their quizzes. So you can make up classes and make up homework, and I'll work with you as much as I can to make sure you get your certificates. So now let's kind of get started and fill in the blanks. I sent to you an email on some information on what the answers to these kind of summary questions are to make sure that you're kind of learning what we're doing. And Jody, I'll mention to you, each class when we do a series, we always have some reminders to help us remember what we had the week before. So that's what this is all about. So Dusa Maria and Darcy, if you're available for your chat, how about typing in some answers here for us if you could remember them, and I'll just roll on through. I won't hold up much time to do this. So in chat, if you would type in what the blanks are, because when you're fishing out in the ocean, remember you always want to keep fresh bait in the water if you want to catch fish. But when we're fishing for customers, there's 3 rules that always apply too, and they're the same 3 rules, and that is keep frequent what? What do we keep frequent in the water to help catch customers? We keep frequent promotions to everyone on your database. Build that database of email addresses and send out constant promotions to them. Let them know you're alive and well. Stay on Facebook and send out constant promotions and information that makes people aware of you are in business and you're hungry and you want the business. People will feed someone that's hungry. If you don't let them know you're hungry, you won't get fed. So keep those fresh promotions out there and help folks find you. In the chat questions now, number 2, we talked about last week, it related to bookkeeping. The bookkeeper's, the accountant's job is to focus on the annual reports and the tax returns and filings and such as that. But the bookkeeper's focus is on what? The bookkeeper's focus is on the daily and monthly reports. The daily and monthly reports. The bookkeeper looks at the short-term issues with your accounting. The certified, the CPA, your accountant looks at the long-term issues. Sometimes you can have the same person doing that. Most people have a bookkeeper, and then they have someone else that they use for their accounting purposes. Number 3, talking about marketing mainly. If you want your business to be more sustainable, it's important that you diversify your marketable profit centers, that you diversify the ways that you're going to make money, and have at least how many? How many profit centers do you really want in your business if you want to feel like it's going to be sustainable? How many? That answer would be 5. You want at least 5 profit centers. But just as important now is you want to have products that you're offering, products that people want and products that people need. Having that diversification is very important, because having things that people want, you'll make usually more money on those items because it's mostly impulse buying. But you also want things that people need, and they need to know that you have it for them, so they will come back to you on a regular basis, and you'll be ready for them and have the product they need. If you have products that people need, you will see more business, more repeat business, more regular business. If you have products that people want, you have good stuff, you'll probably make more money on those as well. But the mix is what we're trying to achieve for you. Week before last, we talked about search engine optimization, SEO. Do you remember those discussions? And they teach us to focus on the content of our web pages so that we can improve our ranking when customers are shopping for us. So we really want to do what? Why do we want to focus on SEO? To help customers find you. What's the best way to find customers? Help them find you. So really, really important, okay? And each week we've added a word or two. Excuse me. We've completed 5 weeks. Could y'all remember any of these words that we did? First week in it, starting with S. How about typing into your chat there if you remember what that word is? There you go. The word was shrewd. The second week, the word started with M. Anyone got that? Started with M. That's right. Thank y'all for typing in. Yeah, how about mindfulness? Remember mindfulness? And number 3, A. What was number A? Well, what was week number 3 that started with A? Assertive. Yeah, I've been a little assertive during the last few weeks, I know. And week 4 was E. And we all need to remember this word. It's so important. And that word would be endurance. And week 5, we talked about last week, we talked about the importance of the word resilience. Resilience. So very important that we have to bounce back. Shrewd, mindfulness, assertiveness, endurance, and resilience. Owning these words and owning these characteristics will help us be better entrepreneurs and better people as well, no doubt. And tonight, our final word in a 6-part series, we're coming right into it. Kind of a serious word. I always like to end up with giving y'all, as we finish up each series, something new and different. I've already got the one picked out for our next series. But week 6 is be still. Be still. We've probably heard that with our Bible verses through the years. It applies very much to where we are now. We will be troubled sometimes. Business is always not fun. We will have some tough times and sometimes be troubled and get concerned and excited and such as that. So what we want to do is remember that when we're troubled, take a moment and just be still and be quiet and meditate. I might have just could have used the word meditate, but I think it's more important than that, because before you can meditate, you kind of got to wind down and get your mind in a state that you can meditate. Turn off the chaos, turn off the noise, turn off the busy chatter. Now, a lot of what I've done during the last 6 weeks is busy chatter, and I know that, but that's what I get paid to do, is to motivate and give you all these things that you need to do. And you and I both know you can't do it all. But I can give you enough of options that you can find things that you can do. That's why sometimes we just have to be still and meditate and focus on those tools that we can put to work and do that. Be still long enough to find and reconnect with your moral strength. Because everybody in business, you and I, we can't do it alone. We need some help. We need inspiration from time to time. Need folks to talk to, but we also need to have self-confidence in ourselves. So learn just to meditate from time to time so you can reconnect with the things that you really need to do, and then get up, make up your bed nice and tight early in the morning, and look back at that bed and say, okay, I've accomplished one thing today. I'm ready to go out and tackle the world and complete my priorities. But before you do that, make sure you got your battery charged and you're ready to go. In the military, we had to make up our beds every day so tight that a quarter would bounce off the sheets. And finally, a fellow told me the other day, the reason that the military always does that is so that people can say, I got up this morning and I accomplished a project and I did it well, so I'm leaving out ready to meet the world with a positive attitude. That makes sense to me as an old veteran, so maybe it's something that can help you as well. We have to keep that endurance going on, though, to stay in the game. And y'all that have stayed in the game through this process, I congratulate you. And it's just another step in the journey. And I'm so happy that we have done it together. Tonight, we're going to focus on the basics of someone new in business about record keeping and depreciation and taxes and selling secrets. And Darcy, as you start in your first week, this is the first week that these topics will become more and more important to you. So you pay good attention tonight. And if you have any questions as you're getting your bookkeeping and all started, let me know. If you need someone to help you with your books or to help get your system set up, I can make some recommendations if you haven't already found them from members of the Academy that have been working with us as we've gone along. Record keeping, paperwork, and if I can turn my camera and show you my office around here, you can see that, Steve, you need to start doing what you're preaching, because it is time that we all, tax time and end of year records, look out for our record keeping. So let's talk about that a little bit. Some records you're supposed to keep all the time, and how you keep your records are going to be very important. Of course, there's always the paper filing cabinets, and I can tell you that I don't care how much you depend on your computers or use your devices, you're going to create a world of paper. So go ahead and get your 1 or 2 4-drawer filing cabinets, because you'll need at least that to get started as your business becomes serious. You also want to keep as many records as you can on your little flash drive that you can plug in and out of your different computer in case one of them goes bad. And there's a lot of other different types of ways that you can store your computer files on the cloud. But the paperwork is going to remain important forever, because some documents you have to keep for a long, long time. And that, whether you're storing them in-house or off-site or in a storage building or in your attic, just remember, please try to keep a place that's going to remain dry, even in storms, and a place that's fairly secure. Very few people have records stolen. Not many people are interested in creating a crime to get some old business records that ain't worth anything to anybody. But a fire or a flood will destroy your records, and that'll cause you lots of grief. So keep that in mind as you're set up and organized to do it. The records that you don't need to keep permanently are very important. That's your articles of incorporation, your LLC documents. Through the years, you'll keep your accounting audit reports, copyrights and patents, certain things that are important to you like that, stock certificates, and if you're buying property deeds and mortgages that are related to it. Those documents you have to keep for just forever. So find a place that you can do that safely and do that. Some other items that you will need to keep are tax returns, trademark registrations, different permits or licenses that you get. So find a place to put all that together where it's safe and that you can get to it when you need it. But it can be boxed up. I like to use banker boxes and write on the outside what years it's all about. So that's your permanent stuff. So some items you'll start out right away, just like keep permanently. As a matter of fact, on one of your filing cabinet drawers, you might just write permanent files. Most of the other things that we're concerned about, you're going to need to keep for 7 or 8 years. The law calls for 7 years, but I like to recommend you go 8. Because every year after you've already boxed up your stuff, some other documents will show up that you need to keep, and it's easier just to put them in this year's file. And always remember that you may have some files that go over a little bit in each year. So keep your boxes 8 years, then you'll know that you're always covered. But in the 7-year bunch, you don't need to keep things like your accountant's ledgers, bank statements, bills of lading, different types of records, employee records if you have them, especially after they've been terminated, and different types of expense reports. I will mention here that the bill of lading, you may not be familiar with that term, bill of lading. That's a shipping document that proves that you shipped something from point A to point B, where you shipped it from and where you shipped it to. The reason that those are very important in these days is that when you're shipping items out of state, customers are buying things from you and they're out of state, there are times when they won't have to pay tax on them, either because of certain exemptions they may already have, or maybe you're not doing enough business in that state that you have to keep up with taxes to it. At any rate, you need to know what applies. So Darcy, let me recommend to you right now, if you haven't already found out through the North Carolina DOR, and when you sell items out of state, if you are planning on doing that, do you need to charge sales tax on them, and do you need to report that to the other state? Now, I've told you what you need to do. You can play ignorant on this and find out as time goes along, if you like. Or if you're not planning on selling out of state, you don't worry about it. Or if you are planning on selling out of state, then you might want to put a North Carolina address and charge a North Carolina tax, and North Carolina will be happy anyway. But at any rate, you'll figure that out as you go. Maybe talk to some other people in the same business you're in, and get the details on that. But bills of lading, if you are shipping out of state and you're not charging tax, if you have a tax audit, then the auditor is going to ask you, why didn't you charge these people tax? And you say, because I was shipping to them out of state. And then they're going to say to you, prove it. And you prove it by pulling out your shipping document. It's a good idea when you're shipping out of state and in state, if you can, and you have your shipping document, or on your shipping invoice, you list down how you shipped it and what the pro number was, or the shipping number, or the tracking number. That information will show, and you can go back and look it up, that you didn't have to charge tax because it went to a certain place, and you can prove it. The proof of shipping is a bill of lading. Sales tax returns are very important. Payroll records you have to keep for 7 years. Canceled checks, your checkbooks, your stubs, inventory records, all those you need to keep. Now that sounds like everything, doesn't it? But it's not. No, and you'll still get a lot of junk mail and a lot of things that aren't important that you have to keep. So it's a good idea to keep a copy of this. So as you get started, you can check off the things that you need to put in the filing cabinet and the things you don't. Now we live in an area where hurricanes come through from time to time, and we live in an area where tornadoes may happen, and we have some floods and such as that. If that happens, indeed, your business may go defunct. It may put you out of business temporarily. And when we have what we call a disaster, the President of the United States can and usually does declare an area a disaster area. That has to be done before FEMA, the federal government agency that comes in that helps management during disasters. When FEMA comes in, if you were damaged to a point that it put you out of business or really hurt your business, or you have some type of claim that you can make, then there's always going to be a requirement that you prove what you're claiming, that you prove your loss. And to do that, that means you're going to have the records to prove it, your tax returns and your sales records, your profits per month, those kind of things. Because you just can't say to the FEMA agent, hey, I lost $20,000 in business because of this disaster. So can you reimburse me? And he's going to look at you and say, no. But maybe I can reimburse you the profit that you would have made on the $20,000, because that's all you would have ended up with, and that's basically all that you lost. So then it's time for you to show your financial records and show that you had reported that you made profit during that period of time. So here is the conundrum. we are trying to pay as little taxes as we can, as we'll talk about later tonight. But also, we can't claim we had a loss if we didn't report it on our tax return. So that's a two-edged sword. And as we're getting started in business, and as I recommended to one of our Academy members in private talks this week, sometimes, especially as you're getting started, you really want to show a profit. Yeah, it's a great thing to be able to be a new entrepreneur making profit in your business and knowing that you're proud of that fact and knowing that you are looking forward to paying the taxes on the profit that you made. So don't always try to cook your books or do things in such a way that you don't show any profit, because that's going to hurt you two times. The first time it's going to hurt you is when you go try to borrow money based on your profitability. And the second time it's going to hurt you in case you have to deal with FEMA and have to prove how much money you lost. Okay, so keep that in mind. As you're first getting started in business, try to show all the profit that you can pay the taxes on, and be happy and fortunate and grateful that you can. Now let's talk about depreciation a little bit. Depreciation, well, appreciation is what I do for you. I appreciate you being here. But depreciation has several different meanings out here in the world. And we're going to talk about the one that's related to taxes and assets that you're buying for your business. It's a complicated subject, and you can go to universities and colleges and take special courses and spend months and years studying how depreciation works and different ways you can manipulate it to help you in your business. We don't need to do that right now, but you do need a pretty good understanding of what it can do for you, and that's my job to tell you. But in the effort to do it, I'm not going to be able to spend as much time as I would like for you to understand. So I found on the internet where Lisa Borga had written a couple of pages with a good definition and application of depreciation comments that you'll find very, very helpful. Very helpful, especially in a business where you're going to be buying assets that you will need to accumulate, because the depreciation is going to save you some money in the long run. So just keep that in mind. If you have a chance during the next few weeks or as soon as you can, read what Lisa had to say. It's in the handout that I am sending to you. But now I'm going to talk about in the general basic terms, and I think you'll get a good understanding if it washes in. If it don't come in too clear, then come back with us on April the 9th. I'll go over it again for you. But depreciation, whether it's a car or a truck or a hammer, is a devaluation, a reduction in the value of an asset that you bought. Because it's something usually, as it gets older and we have wear and tear, it's worth less money than it was when it was brand new. Those assets like machinery and equipment and tools, real estate, automobiles, things like that, they depreciate pretty rapidly, and it can really make a difference in the value of your business, because that items that you have bought are the assets of your business, and as it goes down, that means the value of your business will go down a little bit. So as we operate in a company, in a business environment, also it's important that if we want to grow our business and we need to buy new tools and assets, that we'll use up our operating money, our cash, to pay these bills or to buy them or to pay the monthly payments on them. So we need to figure out a way that we're not hurt too badly for buying the tools we need to grow our business. Well, that was a discussion that was held in Congress many years ago after the Depression. And Congress decided to enact tax laws to encourage businesses to improve themselves, to build their businesses so they could hire more employees. Hence, they came forward with the depreciation tax considerations, and that's what I want to explain to you. Let's say that you've got today $10,000 in your bank account, and I congratulate you if you do. And therefore, today your business is worth $10,000. That's easy to understand, right? But to make your business go forward, you need to buy a $5,000, say, industrial saw. Darcy might need to buy a $5,000 cooler to put her cut flowers in to keep them a few extra days. But anyway, we need to spend $5,000. We don't have the 10. So the question is, if you take that cash out of your checking account and you buy something with it, does that mean that the value of your company is decreased by the same amount? Does that mean that if we buy this $5,000 saw, will our company value go down to $5,000? That's the question, and the answer is no, it will not, because the company still owns that asset worth $5,000, and they still have $5,000 cash. So the $10,000 total is there for one day, but only one day, because as the days go by, that saw, those assets decrease in value, and we have to keep a record of that. Okay, that's called, as it decreases in value, it's depreciating. So here we go, just like it's right here on your screen. You still got the cash, that's an asset. You still got the saw, and while it's brand new, it's worth what you paid for it. So that's a $10,000 total. But now let's look at a 5-year plan so we can depreciate that saw over 5 years on our books. First time I've used the word books, because from this point forward, we're going to be talking about book value. Depreciation affects your book value of your company. Over 5 years, we're going to depreciate this thing right down so that after 5 years, it will not be worth anything. The saw's not going to be worth anything on our books. So we're going to take $1,000 a year and depreciate it as we do that. Now that's for the book value. Indeed, the saw still may be worth a lot of money, but on our books, we're going to take it down to zero because we want to do that. We really do want to devalue the saw on our books in order to take a tax deduction as depreciation, because as we deduct and take that value off of our books because of that saw getting older, you're able to take $1,000 a year directly off your taxable income that you pay taxes on. So depreciation becomes a tool to help you manage the value of your assets, and at the same time, let that money you spent 5 years ago keep making money for you each year. Because if you're making good profits and you can reduce that profit exposure by $1,000 a year, that means you're going to pay less taxes. Didn't mean to say that you're going to pay $1,000 less taxes, but you will pay less taxes on the total that was $1,000 less per year because of that devaluation. And we're just talking about one saw here. So if you bought trucks and cars and other equipment, computers and furniture and fixtures, indeed that number could be very, very significant to help you have a year that maybe you actually made a lot of money, but you were able to take enough depreciation to lower that tax exposure down, and you didn't have to pay much at all. That's where a depreciation comes really, really important for you. We'll talk about it a little bit more, but remember, so far we've talked about book value. We'll get back to this, okay? Now, different types of expenses apply for all of us. But in business, we have to kind of break it down into one or the other of a type of expense. One expense would be just called a regular business expense, just items that we buy and we use up and we don't have anything to show for it. But the ones we're going to focus on more so are capital expenses. Those are expenses where we're buying items like that saw that's going to hang around and have value and become an asset. Things we bought with the business expenses do not become assets. Things you buy that become capital expenses, that is, where capitalize them, is something that becomes an asset and helps your business show more book value. All right? So what type of items come into this play that we're talking about? Let's talk about that. We'll come back to it. When I'm talking taxes with new accountants or bookkeepers that I meet, and I ask them the experience was, what is the most important thing that I can say to my new friends and clients? What can I mention to Jody and to Darcy that maybe will help you the most and stay out of trouble tax-wise? And the answer is always the same. And that is, as you start doing business and collecting different types of taxes, sales taxes, or you have employees and you know that they don't have taxes related to that employment, it's really important that you have a focus on that, a mindfulness on that, so that you are pigeonholing the taxes before you have to pay them. That is, you have a mindfulness in that you're pigeonholing the amount of tax that you're probably going to owe at the end of the month or the end of the quarter, whatever type of tax it is or whenever it's due, so that you're not caught by surprise. You're not caught by surprise when you have spent all the money you had because you wanted to pay your bills or lower your debt or to do this. In other words, you were just paying your bills and going along using up the money you had in the bank, but included in that money in the bank was tax payments. And it will happen. It will happen so easily. So I'm giving you a great big red flag here. Please remember to pigeonhole money that you're going to need to pay to the tax folks. It's going to be very important that you do that. That way, when it needs to be paid, you'll be ready to do it. Because let me give you just some good free advice now. If you don't pay your taxes on time, you're going to get in trouble. You don't have to pay penalties. You don't have to pay interest. You don't have to ask a lot of hard questions. And if it's a big enough deal, those tax folks will come and shut you down. They'll put a chain and padlock on your door and seize everything you got. So pigeonhole money that's got to go to taxes later on. Just remember to do that, and you'll be a lot better off if you can. There's a lot of different types of business expenses. Let me just take a breath here and ask. We see that we're honored to have Ruthie Holloman with us, our director and host and sponsor for tonight. Ruthie, is there a chance you have your microphone where you can say hello? There you are.
Good evening, everyone. Thank you for coming out to tonight's webinar.
Okay. Well, I've told everyone that they need to fill out that survey and get it on the way to you as soon as they can, and I will send them a link tonight, but maybe we can get it in before they go to bed. Do you have any comments for us?
Thanks for completing the webinar.
Okay. Well, thank you for joining us. Glad to have you. Stay with us as long as you can. Okay, let's talk about business expenses now. There are certain kind of expenses that after you pay that money, if it's gone and it's intangible, if it's evaporated, then that's just going to be a general business write-off. Write-off. What you're saying is, I'm going to write this number off of my exposable tax exposure. So those are things like rent, business travel, payrolls that you pay out. These are all deductible expenses. And when I say write-off, I could just as easily be saying deductible business expense. They mean the same thing. You can trade those two words any way that you want to help you get along. So as you're buying things for your business, keep in mind, and I just suggest you do it. I do this. One of the things that's in my DNA is I'm writing a check. When I'm paying for stuff, I need to be saying to myself, is this a general write-off or is this something I need to mark as a capital expense and tell my bookkeeper we need to call this a capital expense and start depreciating it? Because if you don't tell your bookkeepers what you're doing with it, they won't know. So as you're writing those checks, just remember, and sometimes you can just make a note on it. If you come across one of these things that is a capital expense, and I'll mention more on for you tonight, then make a note in your checkbook so when you're talking to your bookkeeper, you'll remember to tell them to put that over into the depreciated items. So capital expenses are items that have shelf life. They are tangible, generally will last a year or longer. things that you might have to borrow money to purchase because they would be tangible things. So these are important for you to remember and to note, and to know that as you're buying these items, you are increasing the book value of your company. And the book value of your company is one of the items that lenders will look at when they're thinking about loaning you some money, okay? Just always have that in mind. So let's say we're going to buy a printer, a $250 printer. I've got one sitting right beside of me here, and I don't buy printers but about once every 10 years, so this printer is going to last me a while, so I will consider it a capital expense in my business. But an insurance company that has adjusters all over the country, to thousands of them, and all of them have their own printer, the insurance company would not call that a capital expense. They call that a throwaway item because they know they're going to have to replace it probably in a year or two, and they would just write it off, because when you capitalize something, it goes on your depreciation list, and you have to monitor and do book work on that at least for 5 more years until it's written off altogether, or maybe even longer than that. So there is a little bit of a disadvantage by putting something in depreciation, and that you have to monitor it and keep up with where it is. Because if you've got something listed as an asset on your depreciation sheet, and a county auditor comes along, or someone's just checking you out for a loan, and they want to actually physically see your assets, that's where they're going to go. They're going to say, okay, here's your depreciation sheet. You've listed these items as assets. Now show them to me. So you don't want to put anything in your depreciation records that you can't account for later on. But if I was buying a $2,500 printer or a $5,000 printer, no doubt about that. And most of any other company would keep up with what that serial number is, what the date you bought it is, so you can start depreciating it and getting some tax help with it. But how about the paper? Bought a $250 case of printer paper. Would that be a capital item or a depreciation item or a deductible? It would be a deductible, a write-off, a general expense. Paper, you wouldn't keep up with that because you're going to use it up. It's not going to hang around for a year or longer. Tires that go on your truck. When I bought $2,000 worth of tires in my business, they would probably last me 8 or 10 years. I would depreciate them. That would help my net worth of my business. But if I was a big trucking company with thousands of trucks on the road, I'd have written it right off. $17,000 engine, in my business, I would indeed do depreciation in it. So even if you're overhauling something that's old, but you're making a major improvement on it, that you can keep up with how much it costs you, that's something that you can depreciate. Now, I mentioned this. Let's say that you're building your home office, or you're taking your home now and you're going to really improve it. You're going to make the changes into it as you need to become your new office. You'd keep up with that. You would call that as a capital expense for office such as that. Keep up with all the individual records, and you could indeed depreciate that because that's an asset, but it needs to show that it's an asset of the company if the company owns it. Now, if the company doesn't own it, like it's your own home and the company doesn't own it, then you can lease that office to yourself. You can still take the write-off on it as a lease improvement, and indeed take care of that. Where's another application that would work? Let's say that Darcy's getting ready to go rent her a storefront somewhere, and in that storefront, she rents it for a certain amount. She has it in her lease, but the very minute she moves in, she needs to make $5,000 to $10,000 improvements in it to make it suit her store. Then, Darcy, you can keep a list of those improvements, call them leasehold improvements, keep them itemized, and you could use that as a capital expense and get a real good depreciation kick on that to help save you some tax money. So that's a good application that we can talk about right here. Rent, no, that's a deduction. You cannot capitalize or depreciate rental on anything. Payroll, same thing. It's not tangible. Fees of any type, CPAs or anybody else, is not tangible. Therefore, it is just a plain deduction. Shop tools. Let's say $4,000 worth of shop tools. Indeed, you can depreciate that. But most of you will, just like me, will not go out and buy $4,000 worth of tools at one time. But we will add things as we go along during the year, $100 here, $50 there, such as that. If you keep up with those expenses during your year, and they're all tools, and they all can be put in a toolbox. You can show them to an auditor later on, and you can prove how much you pay for them. Yes, you can take those tools, and you can consider them an asset and start depreciating and realize some tax advantage with it. Now, I'm using the word tax advantage. I'm using the word deductible. Those words are words that we would use to help lower our tax exposure at the end of the year when it's time to pay taxes. That is not tax evasion. No, that is not tax evasion, that way of thinking, but it is tax avoidance. And tax avoidance, as I'm showing you right now, different ways that you can depreciate items is a good method of tax avoidance, totally legal, and something that you really need to understand how to do. The rent on the forklift was $1,000 a month. Can I depreciate that? No, you can write it off. Delivery cost on something? No, non-tangible. You can't just write it off. But after renting a forklift for 24 months, I've got the option to buy it for $5,000. I did it on a rent-to-own plan. Yeah, so I've already got $24,000 in the machine as rent. I don't have it in the machine. I was just paying rent. But now I can own that $20-some thousand machine for a $5,000 check, and I'm going to do it. So the $5,000 payment for that forklift will be a depreciable item because I am buying an asset. I'm buying a $20-some thousand forklift, but only paying $5,000 for it. It will go on my books for $5,000. My book value will increase $5,000 with that forklift, even though that forklift is still worth approximately $20,000. This is where we draw the line, and one reason it's important that you pay attention here. The book value went up $5,000, but the fair market value of my business went up $20,000. So as we talked about several weeks ago, fair market value plays a real important role in a lot that we do, especially in our buying and selling, but a lot to do with what the net worth of our company is. The net worth of your company will be gauged in two different ways, book value and fair market value. One can be higher than the other, but you need to always remember to know the difference because it can have a big play on you when you're negotiating. Now let's talk about doing taxes, and man, it is tax season now. Everybody that's has to do it is thinking about getting their records to their bookkeeper, to their accountant, or to their tax person. So let's just have a few comments about things that most people deal with. I want to encourage you to hire someone that's got experience. You're brand new in business. I would not recommend you buy a brand new bookkeeper who's never done bookkeeping before. Even if they're a QuickBooks expert, that doesn't mean they have physically got that internal DNA understanding about what makes things tick. And as a brand new entrepreneur, that's a good thing to have on your favor. Someone that's kind of been around and knows a few things, and other than just what the software buttons are meant to do. I want someone that understands the business. So if you can find a bookkeeper that's familiar with your type of business or has been in business long enough that she got a good grasp and won't get excited and anxious over every new bump in the road, and there will be lots of bumps in the road, then that's what I suggest you do. My bookkeeper, when I started in business, worked with and for me, and I worked for her for 49 years. 49 years working together. That's a long time. And I'm sorry to say that she got sick last year and just had to retire. And I hate it so bad for her, but she's doing real well now. So she's going through treatments and doing well. But I do miss her. But I also had to go out for the first time in my business life and hire a bookkeeper. And it was really an interesting process. But I kept looking. I talked with 6 different people, and I found one that had never been in my type of business, but had been in bookkeeping for about 25 years for a number of different types of businesses. And she agreed to she looked over my records, said she thought she felt comfortable with it, and we'll move forward. So we're 6 months into that now, and so far we're doing real well. She's getting ready to do my year-end work and file some tax returns for me personally, so we'll see how that goes. But find someone with experience, number one. Number two, find someone that you can easily and comfortably communicate with. You don't know the answers to the hard questions. They need to understand that you're new in business, and that's why you came to them to use their experience as well. So keep that in mind. Find someone you can communicate well with. Number two, make sure you know where you're going price-wise. Negotiate a price. You want to get a quotation. You want to get several quotations if you can, so you can compare what your costs are. And here's where I have to caution you. The cheapest one is not always the best. No, the cheapest one is not always the best, even though we need to save money, although we need to avoid paying taxes. You look for some quality and what the end result is. This is one of those things that would be a good time to talk with Ruthie or give me a call, talk about why one bookkeeper may be better for you than the other. And you know what the first thing that we're going to talk to them is? Why don't you get some references from them and talk to those references. That's always going to be the first piece of advice. So know what you're heading. The difference in tax evasion and tax avoidance is really quite simple. Tax avoidance is legal. It is a must for an entrepreneur to know how to find the ways that you can present your books, whether to rent or to buy or to get a rent-to-own plan, whether you depreciate something or not. That's all about tax avoidance. Tax evasion, however, on the other hand, is flat-ass lying, is misrepresenting, is cheating, is really cooking the books in such a way to give a different picture than the truth. So we need to stay away from that because it's dangerous and you can get in trouble, pretty big trouble, by doing that, okay? No tax evasion. The hot buttons that we'll always talk about in our classes, the deductions. That is, what can I deduct to lower my taxable income? So we take up all the money that we make, our revenue, automatically reduce it by our general operating expenses that we just talked about, those business expenses. We reduce it by that much in our cost of doing business. And then we go back and look and see what else can I use for deductions? What did I forget? What can I maybe revisit and lower my taxable exposure some more? The first thing that always comes up with the entrepreneurs in the academy is, how about my home office? How about my home office deduction? Well, let me tell you how that works simply. If you're working inside your home and you have an office set up in your home or you're using that, then the square footage percentage of your total home square footage would be considered your office square footage, and that percentage would be the amount of money that you could deduct. You would achieve that by saying, and we'll use an example, what is your total home footage? Let's say you've got an 1,100 square foot apartment, and you're using the front corner of the living room up there, which is a 10 by 10, 100 square feet. So you're using just over 10% of your total apartment space as an office. That means that you can deduct, you can take your total expense for maintaining your home, rent, landscape, heat, utilities, all the money it takes to maintain your home, and you can take 11% of it and call that a business deduction for home office use. And you can do that. Now, in an audit or in a discussion with an auditor, they may ask you some hard questions, especially if you start getting greedy and expand your size of your office on paper when it just doesn't make sense. You'll have to bring sense to that, and that can become uncomfortable. So just get ready for that. Now, an easier way, a better way, a way that you can achieve more tax avoidance is, if you can, to have a particular space, like an outside building or an outside office. It's a part of your house, but it's an outside structure. It's added on. There's no doubt about where the office starts and stops and what size it is. And you rent as a business owner, you rent that space from yourself as a property owner. So the business starts paying you rent for the office. And you can set that rental pretty much anywhere within general reality. And the business pays you directly each month a rental payment. And also the business pays any types of other expenses that can be identified as part of keeping the house up, including lawn mowing, care, landscape, plumbing, electric bills. There's lots of different things that you can say that was used up in the office, and you can pay with that business expense. You want to keep it in reality because there's always could be a reality check. But the amount of rent that you charge, the company gets to pay you that. It should cover everything that you are concerned about, and that rent is paid to you, and it is taxable income to you. That your company money that you pay to yourself is taxable income. But here's the good news. It is a write-off. Remember, rent is a write-off deduction for the company. Therefore, it's kind of a wash. But you still get the advantages of that deduction and for your expenses, and the company gets it. It's a write-off for them as well, as we just talked about. Meals and entertainment, pretty much it used to be everything goes. You could pretty much deduct anything you wanted to call travel and entertainment. That's not the case now. If items that you want to call travel and meals and entertainment and gifts for your customers, you're going to need to keep a log and document when and where and what it was all about and how much was spent, so that you can come back and justify those expenses. Things that are particularly for your customer, you can prove for them, pretty much you can deduct that stuff. But things that are for you, you cannot. So if you're traveling to a conference or convention, your travel cost and lodging costs are certainly going to be deductible expenses. However, really expensive, luxurious meals and lots of liquors and bar bills and entertainment such as that, probably not. You probably get challenged on those. And if you do it long enough, they're going to look back several years, and that could become a right good size figure. So be very careful there. Generally, folks that are wanting to buy boats to take their customers fishing on them, got to be real careful with that, because that doesn't wash very well. You have to prove you're only deducting the expenses when the customers were on the boat. Insurance. Insurance are deductibles. Very little to say about it. Even life insurance. And the company paying your life insurance premiums, okay, instead of you paying them with after-tax money, the company can pay them with pre-tax money and take the deduction on them. That's a good deal. But you got to remember that the company has to be the beneficiary of those life insurance policies. Now, this changes from state to state and from time to time. It has been, and it still is in some places, I understand, that as long as the company is 51% beneficiary of a life insurance policy, it can pay 100% of the premium, and you get the advantage of the rest of it with your beneficiaries being someone else. As young folks and people maybe going into debt as new business people, and you want to get your debts covered with insurance policies, I strongly suggest you talk with an independent life insurance agent that understands about small business issues. Have that discussion with them and set up an insurance plan that meets your personal needs and the company needs as well. Business training and education, those are easy deductions. You can take them, but you need to document them. The clothing that you're going to wear as you're doing business, if you're a car mechanic or a diesel mechanic or in the lawn mowing business, you don't have the uniforms that you're going to wear, tear up, get filthy, carry to the cleaners, or or to a rental service, you get to deduct all that expense. If you're an executive, then indeed I suggest that you keep up with your business laundry bills, clothes that you're using to do work with, as long as you keep it to a reasonable amount. I deduct those expenses as well, and have for a lot of years. So if you have any questions about that, come. I left out one thing that's important. If you go to the independent freestanding building for your office that's at your house or in your garage or that you've added on, go ahead and do a lease rental agreement, documenting how much that rent is to be paid each month, so that you'll have a document to justify in case someone questions you on that. Tax preparers and collectors. When you're ready to go to the person that's going to help you with your taxes, if you don't have someone help you do them, don't just carry them a big brown envelope of all your receipts and all your documents that you kept up with all year long. If you go to an accountant and you give them a piece of paper, they're going to account for it. They're going to write it down, exactly everything they pick up, because every document will take some time to look at, and therefore it's going to take some money to pay for that time. So if you'll go ahead and organize all your expenses and income and summarize them, and just carry the documents that prove, like your W-2 forms or your 1099s, or your deductible tax issues, your property taxes, things like that. If you just carry the documents that they have to have, it saves you a lot of money. Saves them a lot of time, save you a lot of money. Now, the bookkeeper or the accountant, if they need to see something that's concerning them, they will indeed ask you to show them, prove what you're saying. A certified public accountant has to sign, if they're doing your taxes for you, they have to sign there that that everything that they wrote down here, they're saying that it's legal. As far as they know, they've presented the information that you gave to them, and it's legal and it's just. A bookkeeper or a regular tax advisor may not ask you for that. I would be more impressed with someone that does have you sign a paper that says, what I'm presenting to you is legal. Someone that's not asking you to do that maybe doesn't have enough experience for you. So keep that in mind, okay? Where is your money going? Who's going to collect this money from you now? You got your business started and it's time to start paying some taxes. Where is this going? Well, it's going to 4 different places. And we might call it tax, or we might call it permits or license or estimates or some type of fees or other words. But for right now, let's just call it all taxes. Well, the town governments, they're going to collect a certain amount of money, and that money is usually sent to the town clerk after it's separated out. But the town clerk is who you can talk to about tax issues related to your business in town. The county, and now in most, I think in all of North Carolina, the county collects all the city taxes as well. But the county tax collector, they'll have a nice fancy office for you, and you can generally talk with them with these. They usually are really nice folks in North Carolina. May not tell you what you want to hear, but they're generally cordial and very helpful for entrepreneurs. So don't hesitate picking up the phone and going to see them and talking to them about this or that situation. North Carolina State, North Carolina DOR, is the agency that collects most of the bigger taxes, okay? They collect the income taxes and the business taxes and things like that. We're not going to call them the Treasury. From now on, we're going to call this group NCDOR. And I'm very pleased and feel good about saying to you, this is a good, friendly organization statewide. And they go the extra mile to help entrepreneurs. They go the extra mile to work with your small business centers, and they even put on special programs and webinars to help entrepreneurs get started. But I will tell you this, as nice as they are, even in their regional offices, if you don't pay your taxes on time, they're not nice anymore. No, their personality can change just like that, and they become not your friend anymore, but someone that is hell-bent to get every piece of tax money you owe to the state and to your employees. So just know that. Be straight up and just be ready to face the consequences if you don't play by those rules. The federal government operates as the U.S. Treasury or the Internal Revenue Service, the famous IRS. And they're there and they're real and they're really busy folks and they're understaffed. And I'll say this to you, as nice as the North Carolina DOR people are, the IRS people are probably really fine folks, but they're really hard to find and to talk to. And when you do talk to them, it's going to be someone that's a long way away, and you may indeed not remember their first name, or they remember yours. You're going to be working with your Social Security number probably, or your EIN number. And we'll have to do a lot of business with the Internal Revenue through the years. So here's my advice to you. When you find that bookkeeper and or that accountant, then I want you to be thinking about them. Yes, they're doing these duties for you, but what are the main duties you want them to perform? And you want to ask them when you're talking to them before you hire them, are they comfortable with calling the IRS or the North Carolina DOR on your behalf and getting questions and answers for you so that you don't have to do that? That's good advice. And I suggest that you listen close to it, because your accountant will know the right questions to ask and how to ask them and get the answers that you need without ever mentioning your name. That's the way the rule book works. Your accountant or your bookkeeper, they talk to another tax authority. It's like a lawyer talking to them on your behalf. They don't have to give them the information about you individually. It might keep you out of a little bit of hot water. So keep that in mind. If you go to an audit or you have a tax question or such as that, it's better to let your bookkeeper and or your accountant make that call for you. Okay? With DOR on simple stuff and just getting started stuff, take it right to the North Carolina DOR office or to your small business center when they have a meeting there, or to the webinars or seminars that they put on. It'll be very good. But when it comes time to nailing down a specific issue on your tax return or payment, I suggest you let the bookkeeper or the accountant make those calls for you. It costs you a little money because you don't have to pay them for their time, but it may save you a lot of money and save you a lot of time as well. Okay? Maybe that's the most important thing I'll say tonight, so let it sink in. Sales taxes, you have to pay. What are the different kinds of taxes we're dealing with here? Sales and use tax, where you are selling a product or a service that is taxable. When you collect that money for yourself, you're going to collect a little bit more for the state. It's going to be up to you to send it to the state every month by a certain date, and it needs to be done without irregularity. There'll be withholding taxes for your employees, privilege license for your company, unemployment insurance for your employees and maybe for yourself, and franchise taxes. Some might ask me, Steve, if I don't need to take out Social Security and unemployment compensation on myself and such as that as an employee of my own company. Well, you'll have an option there. If you want Social Security to be paid in automatically, probably the answer is going to be yes. But you can pay yourself as the owner of your company as a consultant. You can pay yourself a consultant fee and not pay Social Securities or take out unemployment taxes on it. However, at the end of the year, that 1099 is going to be taxable just as if it was a W-2 form. So you always want to keep that in mind, okay? Important issue. Usually, there's one or two people in your business, you'll think about it long and hard. But if you're going to do this for a long term, you're young and it's early in your life, and you're going to start this business and grow it with more and more employees, generally, yes, you would go ahead and call you the salary yourself, pay those taxes as you go, and just get used to it, and hopefully add more employees and keep adding them, and move along in a good, steady, sustainable course. Be a good way to do it. There is a little tax that you'll see on your tax return, state and federal, called a franchise tax. And franchise, I'm not going to congratulate you that you've got yourself a franchise Chick-fil-A or a Hardee's or a McDonald's or some other type of franchise. But the franchise tax is there. It's a line on each one of your tax forms. And what that is the government saying, you don't have to pay us a little bit of money whether you make any money or not. We don't care if you lose $10 million, you're still going to pay us $100 franchise tax each year. So I like to say it's the government's way to make sure they get enough money to pay for the paper. But so that's one type of tax that isn't related to your income. It's just if you're in business and you're filing tax returns, then you don't pay that franchise tax every year. Now the county is a different animal altogether. The state and the federal guys, they charge us taxes on what we make. What is our income? What is our taxable income? And they will apply a multiplier on that, a tax rate, and therefore they get a piece of their pie. But the county don't care whether you make any money or not. County don't care if you've lost money or not. The county cares about what you own. The county cares about what your assets are. So we're going to do that full circle all the way back to where we started. Those items that were capital items that we deducted, they became assets of the company. And they were entered into the company books as the book value of those assets. And that could include tools, vehicles, real estate, lots of different things. Different assets, hard assets that you have that are there but are not for sale. They are there but are not for sale. Okay? Because in North Carolina, you do not have to pay taxes on inventory that you have for sale. Okay? You do not have to do that. So if you've got rental items that aren't being rented, if you've got rental items that are out being rented, you're going to have to list those as taxable and pay taxes on those values. But if that rental equipment comes back in and you've got it on your floor on December 31st and January 31st, when it has to be itemized, you will itemize that rental equipment as items for sale if indeed you would sell them. And therefore you wouldn't have to pay taxes on those. But the very minute it goes out and starts being rented, it becomes a taxable item. So there's a little bit of gray area in that as things comes and goes. So that's really important that you work out what the tax avoidance strategy you would use in your particular business to make sure that you're legal, but that you're not got things in the wrong list at the wrong time to make you have to pay a lot more money. Boy, this is a big deal with a lot of folks, especially those people that own big boats. That's why if you go down to the coast there and around New Year's, you'll see a lot of boats going up and down the waterways. And what those people are doing, they're moving those assets to a place where they won't have to pay so much taxes on them. So different places that have certain dates where you have to account for things. So a lot to talk about, a lot to learn there. So as you're building inventory on different items, if you don't have that type of stuff for sale, it'd be a good idea to spend a little bit more time and learn how this stuff affects you. Staying off the auditor's radar system is kind of a thing we want to do. Only about 1% of returns get audited, but you know how Murphy has it, mine and yours could be the next ones that come up. And so we always want to be prepared. We hope we don't, but it's not a fun thing. I've lived through 2 or 3 different audits through the years. They're not fun, but I managed to get through them without a heart attack and stay in business. So, and without a whole lot of difficulty other than the stress that it will cause you. So, but there's some ways that you can avoid that. Now, avoiding the auditor's radar, I think, is a good avoidance to do. So let's talk about that. First of all, you want to do everything you can not to raise a lot of flags. If you're getting ready to venture into a new corner and you don't make some huge change on your tax return, you need to think about how that's going to affect things and just kind of work it out that it doesn't draw too much attention to it. But the main things that draw attention to your tax returns are going to be shady preparers. That are these people that have got their signs up all over the country now that are saying this and that. And some of them are saying, and I saw some this past week that said, I'll guarantee you a $600 tax refund. I've seen some in the past that guarantee people $3,000 tax refunds. They can't do that. They can't do that without knowing right up front they're going to cook your tax return to a point that's going to guarantee you a return coming back. And I'm going to tell you right now, there will be some fine print there that lets them get a large portion of that refund. So you got to be careful with that. Be careful, careful, careful. So if someone's guaranteeing you a return, then I suggest that you keep looking, or you certainly can do qualify them by talking with some other people that have worked for them for at least 5 or 10 years, not 1 or 2 years, because there are scammers out here that will have that return, that check mailed to them. Sometimes it's even made payable to them and you. And when it is cash, they're going to get a piece of that action, and you're going to get what's left. And you're going to have your little bit of money, and they're going to be gone when the auditor comes, and you don't have to face the music by yourself. So stay away from shady tax preparers, especially now that you're getting your business involved in it, okay? Unreported income. Over a period of time, you can get by with a little bit of stuff as long as you don't overdo it, but I don't suggest that you start that practice. Yeah, you know, people give you a tip or a bump here and there, but if this becomes the income and you're counting on that income and it's a major portion of what you're doing, then there's trouble around the corner. The tax folks are really good. They can look at how much money you spent, and then they look at how much money you reported you made, and it doesn't take a rocket science to say, well, how in the world does someone that is showing they're only making $10,000 a year spend $200,000 a year? So they're going to ask you that question. So you better have a lottery ticket. You better have some rich family member that's left you a lot of money, or a trust. There will have to be proof for that. If you're spending way more than you're making, then there's some unreported income somewhere. Being late on filing your tax returns and not getting an extension as you're supposed to, that'll raise a red flag. Getting an extension every year will raise a red flag. If, however, you have an accountant or an established bookkeeper that is requesting that extension for valid reasons, they can generally write that in, or they have that, and they would be the people that the tax people would ask, you probably don't be all right. But if you're just being late to avoid paying taxes you think you can get out of, that's not very smart, because a late return doesn't save you any money at all. If you owed money on April the 15th that you didn't have, and you got an extension because you couldn't pay that bill, you got an extension for 6 months, and well, in 6 months, you're still going to owe that same amount of money plus interest. And if you don't get an extension, you don't owe that same amount of money plus interest plus a penalty. So there's no advantage for dodging the clock. If you don't have the money to pay your taxes, then the smarter move to make is to figure out a way to add a profit center, to borrow some money to pay them, but keep your tax records clean and current, and therefore when it's time that you want to expand your business, there won't be a black flag there. Keep that in mind. So we've talked about a lot during the last 6 weeks and pretty much covered a lot of ground, and I really appreciate all of you staying with us as long as you have. We'll summarize it all back up, but you know, some things are just really, really important that we need to remind ourselves. Remember that we talked about during week 2, the marketing method of take it or leave it. If that's the way we're presenting our products to our customers and we don't give them an opportunity to have something to do with the price, how they pay it, whether it's the freight is free, if we don't give them some type of option to talk about, it is take it or leave it. And if it's leave it, then a lot of people will leave it. They may come back. But if you're giving them the incentive to talk about it, and let's make it comfortable for them to do business with you in your pricing structure or options you give them, you're going to have a lot better chance to make more money. The RFC, the Raving Fan customer, is that customer that does business with you and comes back to you time after time and recommends you to other customers. They are just like having gold in your bank account. They will keep business coming for you in good times and bad times. So as we leave this series this time, remember our goal is to create as many raving fan customers as we can. And then we have to stay in touch with them. And we do that by having a database of email addresses and telephone numbers. But email addresses mainly, because we can take those email addresses, send out email very inexpensively, and encourage people to link on a certain page at your website, your landing page. So as you have more profit centers and more things that you're selling, you will have more web pages, and through those emails you can have people to link on them. Just like tonight, I'm going to email you a link to one of Ruthie's web pages where you fill out a 60-second survey. That's exactly how the process works. And that is what drives internet business. Driving internet business is not having a fancy website. Driving internet business is getting people to go to your web pages. That's where the money is made, when they go to your web pages. We got to remember that the best way to get them to your web pages is how your website, your web pages look on a telephone. What are you doing about your mobile page? Your mobile page is the door that opens up and gets people into those pages. So it's so powerful, and it's so easy not to pay any attention to it, and therefore you can have a great everything. Products, website, pricing, doing it all, but if your mobile page is not really good, folks won't ever find you. They won't ever get to you. There are a few things out here that you can do that will automatically just boost and move your business forward in a big way. And your business on Google account is a huge one. That is almost a freebie. But it don't cost but very few dollars, maybe not even 10 or 20. But your business on Google shows people pictures of what you're selling, tells them about your business, gives them your phone number, gives a map to your location if you want it to, and you can promote ads there for very little, if any, expense, and it's just powerful. So maybe you don't have that website yet, but you can still have a Google My Business account. You can have it even refer people to your Facebook pages. And if you do have a website, it'll send people right there too. But what's even more important about my Google My Business account is that folks can give remarks, give comments, give a report on how good a business person you are. Remember that place that's got the 5 stars, you can give 1 star or 2 stars or whatever? That's that place. And so tomorrow you could go online, get My Business on Google account, show the world that you're here and alive, call 5 of your friends and ask them to go there and give good remarks on you, and by golly, you'd have a great presentation right up there. So you do what you have to do to get your name in front of folks, and My Business on Google is one of the best ways to do it right away. Now, when we send people to our website, it's the landing pages, the page they land on where you encourage them to do business on this page. There's money-making pages at websites, and there's other pages. There's a home page, and that is so important, no doubt. There's your mobile page, and that is so important, no doubt. And there's all these pages of information and pictures and this and that, which I have 1,700 pages at my website, but I've only got about 20 landing pages. And those are pages that I try to send that customer to, and if they're on that page, by golly, I pretty much take 100% shot at them to give me an order right now. That's that place that you motivate. Maybe we ought to stop calling them landing pages and start calling them motivating pages. As a matter of fact, in the next series, I may change the name to landing-motivating pages, because that's what that is all about. Videos are so important. The more videos you have on each page, the more traffic you're going to get there. Just having a video on the page puts you in front of everybody else in the world that does not have a video on that page for that search term. So that's why videos are important. I'm so glad to see a couple of you this past week do more and more videos. Darcy, so proud of you for jumping in there, starting to do it. And Spear Wanky is doing a great job with it too. She is really winding it up. So if y'all are not visiting Sir Wanky's pages, I want to. So check your email. Today you may not have seen it, but I sent you an email with each and one of y'all's website pages or Facebook pages. Go look at your fellow associates' work. See what they're doing. Let them know you're there. Let them know you like them, and share your work with other people. It can really, really make a major difference for you. Now, remember in our marketing plan, we were all about the magic marketing moment. That is, we want to tell our customers that we're going to make them 100% satisfied, and after we make the sale, we don't go back to them and talk to them. And when we have that talk to them, we remind them about our promise to try to make sure they're happy. That's when they become a raving fan customer, and that's when you get to say, now tell me when you're going to be in the market again and what you're buying. Or didn't you mention that your sister is going to be buying something soon? Or what do I need in my company to help me sell more stuff that you'd be interested in? That's the magic marketing moment for our business. That's the moment when you get to make changes for the future that will tell you what's next. And it is a huge, huge issue for you. So the Golden Goose marketing campaign works best when you get in that magic marketing moment to know what's next for your business. So try to do that. So we've covered a lot of stuff during the last 6 weeks, but we're going to wrap it up right now. Last week we talked about negotiating. I tried to give you some good tips. But right now we're not going to deal with sales 101 or selling 202 or salesmanship 303. We're going to go right straight to being a pro. And that's what I want y'all to be. I want you to have that mindfulness and that fruitfulness to go for the top, to be ready to make the deal. And understand why it is. So right now we're going to start talking about sales 404. That means you're a senior now. We're getting ready to graduate into it. We'll share with you some things that I've learned through the years, and I hope you enjoy it. First of all, now that you're in business and you have a chance to start talking with customers and you're in a position to make sales and sell them products or sell them service, your mindset is time to change now with your mindfulness and your endurance and your resilience. It's time now that you think about just plain old A, B, C, and that is always be closing. This is a term that's been used by real estate people all the time because they close deals all the time, right? But we close deals all the time too. But we do it best when it's pretty much in the back of our mind all the time. It's part of our DNA is, hey, I'm looking for the opportunity to close a deal. And when you're doing that, then you'll act differently and you'll do things a little bit differently like a successful entrepreneur. We got to remember that as cool as we think we are, that humility is everything, because folks are not going to do a significant amount of business with you, especially repeat business, unless they trust you. It all boils back down to trust. Remember that noise I was talking about when it's time to be still and just listen and meditate? We need to meditate sometimes about how we can talk with folks and listen to folks so that we can become more trustworthy in their sight, because that is a key ingredient before every deal is closed. So I'll talk to you about 5 different things that people are doing all the time in today's world in one form or another, maybe a cousin, the one I'm talking about, or a relation. But I'm going to talk about some things that I see every day where people are losing business. And I'm talking about folks that have been in business a long time, but they're losing those 1, 2, 10, 15% of their orders because of things they do. And one of them is it okay to take a phone call in the middle of a conversation with a customer? No, and people do it all the time. Say, hey, I need to get this. You mind if I get this? Well, they're nice. They say, sure, go ahead. But what you're really saying is, the phone rings, hey, look here, I get a chance to talk to somebody on this telephone. So I'm going to let you hang there loose while I go pursue this other conversation. don't make any difference how important it may have been. What you're saying to that customer is, you are not as important to me as my cell phone is. So I suggest that when you're moving into a position to talk to a customer and you're trying to close a deal, or you want to have a conversation with them, leave the phone in the car or turn it off. Make sure the customer knows that they are the most important thing that's going on in your life right now, and it will pay dividends to you. Now, I know that while they're talking to you, they may get a phone call and say, hey, can I take this? Because that's what's on people's mind these days. And you're going to say, sure, because you're trying to please that customer. But in your mind, you're going to know right then, because I don't remind you of it, that was not a good move. If they were really into me, they wouldn't have taken that call. So be aware of that, salesperson. Leave your phone away from becoming a distraction when you're trying to close a deal, because it will mess you up. Now, tonight I had a phone call, and this is my sales season, main sales season, and I take calls 24 hours a day, usually by message if it's after 6 o'clock at night. But when you're dealing all over the country, you'll get calls all the time. But all I had to do was reach over there and hit that message button and keep on talking, and hopefully y'all didn't feel like I had a distraction from you. So if you have to keep your phone with you, then you always be ready to hit that message button so you don't have to stop talking to your customer. Please keep that in mind. That's a big deal. Smell. What a strange subject for Steve to bring up, but let me share with you. When you are in close communication, one-on-one, face-to-face, in someone's office or sitting in their car or in their residence, and you have got on real strong smelling cologne that maybe you like that other people may not, or you're a smoker and you just flat stink with smoke smell, or maybe you've got pet dogs like I do, like Otis, and you got dog odor on you. Hopefully you're not chewing tobacco and spitting in a cup, but I've seen people do that. Odor is a big deal these days. People get nauseous. They get excited. They get anxious when they're caught in a trap room with an odor that is turning them off or making them sick. It is amazing. Now, I was a smoker for from 20 to 40, I smoked for 20 years, and I had no idea what the stink was all about. But when I quit smoking, I found out just how stinky it is, and it almost makes me nauseous sometimes to be in a room with someone that's got stale smoke on their clothing or in their room. And if you're going into an office, especially a closed office, especially with women, then by golly, keep this in mind and freshen up. Don't be the stinking person that don't ever get an order, because they will be nice to you, and they will do all they can to be nice to you and hurry you on out. I've seen this happen through the years so many times, so keep that in mind. Just go slow on the fragrance, okay? And stay aware of this. We are in political seasons, and I have people every day on the phone when I'm talking to them or talking to them in person that are dropping hints or making statements about which candidate they love, which candidate they hate. The reason they can't buy something from you is because of somebody's policies. The reason this is because I hate them or I hate that, and they're just baiting me to find out how I feel about it. And my answer is, hey, I'm just here to make a sale and make sure you get a good deal, okay? I've got my political views, and I'll go along with them. Now, I'm not saying yours are right or wrong, but indeed, I do not talk politics with customers. I do not talk religion with customers. When you're trying to make a deal, you go in and make the deal. Now, if you have already surmised that they are exactly in line with you and it would improve your situation, then, let your conscience be your guide. But sometimes people will fill you out even though they're on the other side to see which side you're on, and they will actually hate you. I mean, hate if you don't go along with their way of thinking, and would never give you any business. And the rest of the story is they'll go out in the world and talk bad about you for it. to their other friends who identify with their way of thinking. Now, I have strong political views, and I really am concerned about what's happening in the world, and I want y'all to be too. But I do not want your political views to cost you your business. And in today's world, that could happen. So keep that in mind. Is it okay for me to walk into an office where someone is sitting there in a telephone conversation? Is it okay for you to invite yourself into an earshot of what someone else is saying in a private call? The answer is no. The professional salesman and sales lady would never invade someone's privacy in a situation like that. You never know what might come up on that telephone call, and you never want to be in a position to embarrass your customer or yourself because you invited yourself into a touchy situation. This is important, so you're better off to stay out and say, after you get off the phone, I'll be right there, or just, take your time, go ahead, I'll just wait out here. The person may wave you on in and say, it's okay, come on in. You do not go there. You do not go there, and they will respect you because you have said, no, I want to respect your privacy. Go ahead. That will put you up a scale, a notch or two on their relationship notches, and indeed help your situation in the future. So respect people's privacy, even though they maybe are inviting you to walk in. Lastly, we are going to be in a position doing business with some friends and folks that we know through the years, and maybe it's going to be real easy just to take it for granted that because they asked me for a quotation or I gave them this information, I've got an order in the bag. I'm going to get this business. Yes, count your chickens before they hatch is what this is called. And in entrepreneurship and in small business, there is always someone ready to take the order away from you. And if you give a quote on Thursday and you haven't heard from them by noontime Friday, I suggest you give them a call and say, man, I'm sure hoping I could get this order from you before the weekend. Can we go ahead and close it out now? Maybe you can't close it out, but you'll let them know you're thinking about them. Let them know you're hungry. And maybe there's another competitor trying to get that order just as like them. You don't want to seem too anxious. You don't want to seem afraid, but you do want to come across as being hungry and aggressive. You do want to come across as being assertive, but not pushy. And this is an important lesson for startup entrepreneurs. Be willing to be assertive enough to let folks know you're hungry and that you would really appreciate their business. And just like right now, I'm looking after my order. After you buy this item from me, I'm going to look after you and give you the customer service that you deserve and want. Never assume that the order's in the bag. Always follow up, and follow up as often as you need to. Now, I'm in the business of giving quotes via email. A customer called me up after visiting the website and say, I'd like to get a quotation on this piece of equipment fixed this way, and shipped here, shipped there by a certain carrier. A lot of information going into the quotes that I send out. And I spend a lot of time on them, as you can imagine. So when I send that quote out by email, I know, and I want you to know, that email is very unpredictable. Some systems won't accept email from other places, and the chances are maybe as high as 15% that when you send an email out to a new email address, they will never see it. Either number one, they didn't recognize your email address and just considered it as spam or trash. Or number two, it automatically, because it was a new email address, went to their spam file, which they have never opened. Or number three, maybe your email system don't work with theirs. So automatically have in your mind that if you send a quotation out by email, that on the, not maybe the first day, but on the second day, send a second email out that says, please acknowledge that you received a quote and give me a call if you have any questions. We certainly appreciate your business, or I'll be glad to call you. Follow up. Follow up. Follow up. It's very, very important, and so easy to forget to do, especially if we get really busy and have a lot to do. So I've kind of set a priority on my mind that every Friday morning, part of my Friday morning work is to go back and look at all my email that started with the word quotation. That's the way I set them up. If it's a quotation, I have the subject matter do that. I go to look at my file, and every word that started with quotation, if I hadn't already followed up with them, I send them a follow-up message. And I'm going to start it last week, and it got me an order, so I don't keep doing it. I'll send them a Friday 50 opportunity. And that is to say, it's Friday, and if you call me before 5 o'clock, I'll have a $50 bonus for you. You can take a $50 discount. Now, with my stuff, that's fairly token, and if I plan for it, if I built that into my quotation, which I do, sometimes it just that little extra push make the difference of whether someone want to go ahead and place the order with you on Friday before they spend that money somewhere else over the weekend. So keep that in mind. That might really help you, is to follow up with your stuff. And if you sent them a note and they didn't respond, there's a chance they never got your first or your last email. Then you want to call them up on the phone and see if they got that email and make a correction on the address. All right? That little tip will make you some money. But never, ever think that the order's in the back. People are in a hurry these days, and the urgency to respond is very, very important. So don't wait around and be lazy about responding to people. Sales 404. I want to tell you that never give away information that you don't have to give away. Tell what you have to tell, but your trade secrets, the little things that make you special, you keep that to yourself because you might have to use them for a closing deal. Don't itemize who your subcontractors are, who your suppliers are, because in today's world, people know they can go on the computer and Google different things and maybe buy things from other people and maybe even buy the ingredients you were using and doing things themselves. So keep your trade secrets to yourself. Make every proposal that you're making, remember it's a sales pitch, and to take it very serious when you're making these pitches. Keep that with your manufacturers again. Protect your trade secrets. There are some people that just cannot say yes, and that's what I'm going to focus on as the secret here. Maybe it's not so important they can't just say yes, but I don't take it at that point. For some reasons, different reasons, folks have fences and gates that keep them from closing deals with you. And we have to learn as professional salespeople how to move around that. What is the secrets that help 5% of all the people in sales get 85% of the business? Yeah. Why do 5% get a lion's share of the big orders? Because they know little things that make a lot of difference. And here's some of the little things. Some people will fight buying something even though they want it, even though they've got the money, they just hate to turn loose of it, or hate to make a change, hate to do something different. And it's like they're crying and struggling to get away from it. Well, here's the way that you kind of get away out. Good tips to help you around that. First of all, it's your preparation. Like we talked about last week, when you're getting ready to go into a negotiation, make sure you're ready to do business. Have your paperwork ready, have your forms, your specifications, your frequently asked questions. Be ready to do it, and it looks good. It looks professional. Back in the 1700s, there was a fellow, Dr. F.A. Mesmer. I don't know if you ever heard of him or not. I hadn't before I did a little research. But he came up with a plan with a word that applies to us tonight. And Dr. Mesmer gave us the word mesmerize. He determined that with our different skills and the way that we conduct ourselves, that we can indeed spellbound and entrance and grip or hypnotize or dazzle folks to a point to take their mind off what they were thinking about and get them to focus on one thing. I think of my grandson Colin when he was a baby and spent a lot of time with him. As he was growing up, SpongeBob SquarePants was the mesmerizing thing for him. He'd sit on the floor in our den in front of the TV. If SpongeBob was on, the whole world went away. What we have to do as professional salespeople is to learn when we're making that deal, when we're closing that sale, we need to learn the techniques to help us mesmerize our customer and help them get rid of the anxieties they have. It's very much like a theater stage. A sales presentation has a beginning, a middle, and an end, and a way to get there, and different tools that are used. You've seen this work at church. You've got some ministers that are just fantastic, and they know how to put the music together and their motions, their rhythm in the way they're talking. They know just when to use the right hand signals and how to quiet their voice down to make the point they need to make at the right time. What they're doing is bringing you to that point where they've mesmerized you to get the message, So we've got a baby, and baby's got colic or whatever, is crying to the top of his voice. It's been crying for hours. It's getting late in the night. You've wore out your hip rocking it. You rocked and sang all the songs you can think of. Even took the baby out in the car and drove around the block so that maybe it would go to sleep, and still crying at the top of her voice. And then all of a sudden you're holding the baby and you look down into her eyes and that three-pointed mouth, and she goes, makes that great big yawn, makes that aha sound. Well, that's the aha moment in salesmanship. In every professional salesman, every professional person closing deals knows that you have to be in a position to recognize and smart enough to recognize that aha moment. Because at the aha moment, if you've done your homework and the people like you and they trust you and they know you now well enough to let you be with them, and they're listening to you as you're making your presentation, as you're making your pitch, there will be a place that you make them know that they're getting a good price value, that you explain to them the warranty and the reputation is good, and they can be very comfortable with you and with your product. And you'll get to the point when you're shaking your head and using your hand gestures like this, that in just a second, you'll see them relaxing. They have made that aha moment, and you've moved from talking to closing. You move from selling to closing the deal. And if you get your gestures just right, and you're shaking your head as you're giving that yes signs, in a moment, you'll see that their heads start shaking as you do. You've talked with people and they'll agree with you, they'll nod your head. And at just the right moment when you think everything's good, you say to them, all you got to do is just sign right here. Just sign your name or draw a circle. Or reach out to them with your hand. You were going like this and shake hands with them, give them the nod. Or sometimes it's as simple as saying, you don't have to say yes, just give it a nod to move forward. More big deals are closed like that than waiting for someone to say, yes, I'll take it. Yes, I'm excited, let's do the deal. Yes, I want to hand you my money. Very few folks are going to do that, especially in a meaningful deal. But if you have been the professional salesman they want to do business with, they will give you the nod, let's go forward. They will initial and circle up or sign their name without ever saying yes. But you have learned how to make that presentation to mesmerize them. And when you get that deal done, the rest of the presentation is to feel congratulations and say to them, wow, it was a pleasure to work with you on this, and you have really knocked it out on the park. You're a great negotiator, and I'm so proud that we've been able to work this together. I hope you'll give me another chance in the future to do business with you, so maybe I make a little money on the deal, but I do appreciate working with you. The key to entrepreneurship, the key to winning the race, the key to winning the race is staying in the race till the finish. And you stay in the race to the finish by telling your customer how great they are and what a good deal they made and how much fun it was to work with you. That indeed is when you are becoming a master and you learn to respect every person, you maintain your high standards, earn trust, you foster partnerships, embrace excellence, and take time to be still and know. So God bless you. Thank you for staying with us through this series of lessons. Look forward to hearing from you. I look forward to getting comments. And if you'd like, you can turn your mics on and we'll discuss anything that you'd like. And remember, in a few minutes, we're going to email you a form to click on to send back to Ruthie. So thank you so much. Look forward to seeing you in the next round.
I also put the survey in the chat if anybody would like to go ahead and click on it now and go ahead and take that survey. Let us know how Mr. Carver did, how you liked his webinar tonight.
All right. Well, thank you for staying with us tonight.
Thanks for having me.
All right. A special congratulations to Darcy. We're so proud of you and wish you the very best as your first week in business is good and moves forward. And we wish you a lifetime of good business. So God bless you and all that you're doing. And the rest of you stay cool. So good night, everybody, and God bless you.
Thank you. Good night.